Welcome to The Explainer. So today, we're going to completely break down how professional traders actually read charts. No myths, no fluff, just the reality of how the pros do it. And honestly, it's probably the exact opposite of what you've been trying. By the end of this, we're going to take your whole perspective on the markets, flip it upside down, and shift it from all those confusing myths straight into actionable mastery. Ready? Let's get into it.
Okay, let's dive into this. What if I told you that almost everything you've learned about trading so far is, well, wrong? Look, I know that sounds a bit harsh, but it's highly likely to be true. See, amateurs are usually taught to hunt for this perfect strategy, staring at a chart, trying to magically predict if a price is going to go up or down. There's this huge trend right now of treating the markets like a giant binary game, red or green, almost like you're at a casino. But that whole guessing game, it is literally the most destructive mindset you can have if you want to protect your capital.
So you really got to ask yourself, what if trading isn't a guessing game at all? When we try to guess, we end up chasing perfection, hunting for that mythical, impossible 100% win rate. But here's the cold, hard reality. The market is fundamentally unpredictable. Nobody, and I mean absolutely nobody, knows exactly what the market will do tomorrow or even 5 minutes from now. Trying to perfectly predict something that's unpredictable? Yeah, that's a trap. It'll drain your account faster than you can blink.
Let's put this into perspective. 30%. That was the win rate of Jesse Livermore, one of the most legendary traders to ever live. Now, by amateur standards, a 30% win rate sounds like a total disaster, right? I mean, if you got a 30% on a test in school, you'd fail. But he was phenomenally successful. Why? Because guessing perfectly just isn't required. When you have a massive risk-to-reward ratio, the times you are right completely wipe out those small losses. It's not about being right every single time. It's about how much money you make when you actually are right.
So if they aren't guessing, what are the pros doing? Well, they rely heavily on something called behavioral finance, and this is about to become your new best friend. It basically means observing repeating human behaviors in the markets to build a profitable strategy. Let's think about it logically for a second. Who has been running the financial markets since the beginning of time? Humans. Sure, we have algorithms today, but humans program them. And human psychology, that hasn't changed in thousands of years. We still react the exact same way to a perceived threat or a massive opportunity.
And this brilliantly illustrates exactly what drives those humans. It's the most basic primal instincts imaginable: greed, fear, the fear of missing out, good old FOMO, lust, and hunger. I mean, we've all felt that panic when a trade suddenly turns against us, right? Or that intense greed when a stock just keeps going to the moon and you desperately want in. Because human behavior is so predictable, their actions in the market become predictable. When millions of people act on those exact same emotions day after day, year after year, they start creating repeating visual patterns right on the charts.
Which leads us to the real paradigm shift here. It's time to stop guessing and start pattern recognition. You really don't need a crystal ball to predict the future. You just need to recognize these emotional behaviors as they print in real time. Once you spot a behavior that repeats over and over, you just observe it, test it rigorously, and build a powerful strategy around it. It genuinely is that straightforward, but it requires completely flipping your mindset.
So let's act like we're mentoring right now and jump straight into the practical application. Finding one of these repeatable patterns really comes down to 4 simple steps. Number 1, define a time window. Something like the New York Open, where volume and emotions are running crazy high. 2, draw your zones, like those crucial 1-hour support and resistance lines. 3, wait patiently for a break and a retest of those zones. And 4, confirm your entry. Let's actually look at what this setup looks like in the real world.
Now, what's really interesting about this slide is how incredibly specific we can get to create our observation. Let's take a classic setup on gold. Our asset is gold, our time frame is the 1-hour chart, and the action we are waiting for is that break and retest. This is our core observation. Notice what we're not doing here. We aren't guessing what gold will do. We're simply waiting for the market to show us this exact scenario during a highly active, emotional time of day. If it doesn't happen, we just don't trade, period.
But just spotting that retest isn't enough. We need absolute discipline. And that brings us to the 15-minute confirmation rule. See, once the price breaks a 1-hour support or resistance level and comes back to retest it, we don't just jump in blindly hoping it holds. No way. We switch down to the 15-minute chart and we wait for a 15-minute candle to actually close in the direction of our trade. That closing candle is your crucial confirmation. It tells you the pattern is holding, the panic or greed is fading, and market psychology is definitively moving in your favor.
You do have to be careful, though. You absolutely must beware the false breakout.
Here is a super important nuance straight from the charts. Sometimes you'll get a break, but there's no real momentum behind it before it comes back to retest. It just kind of lazily drifts over the line. If there's no significant momentum driving that initial break, it might just be a false breakout designed to trap eager traders. Take that trade, and it could lead straight to a stopped-out loss. You want to see a decisive, aggressive move before that retest happens.
So the crucial point here is understanding the massive difference between a simple pattern and a true strategy. A pattern, like our New York Open break and retest, that's just an observation. It's just taking note of what the market is doing right now based on human emotion. But a strategy? That has strict rules, a proven entry model, and ironclad risk management. Amateurs trade loose patterns they saw once on social media. Professionals trade strict, calculated strategies built around those patterns.
Let's break down the anatomy of a complete strategy. To trade like a pro, you need an entry model, like that 15-minute confirmation candle we talked about. You need uncompromising risk management. You need strict stop-loss placement, usually tucked safely just beyond your support or resistance zone so you know the exact second your idea is invalidated. And you need a defined risk-reward ratio, like a strict 1-to-2, meaning you risk $1 to make $2. The pros observe the repeating pattern first, and then they attach these strict, unbreakable mathematical rules to it.
And here is the ultimate secret of the pro trader: 100. Once you have your pattern and your strategy rules defined, you must backtest it a minimum of 100 times. And honestly, here's the truly hard part. You have to do it without lying to yourself. Don't scroll ahead on the historical chart, see that the trade goes up, and magically decide, oh yeah, I definitely would have taken that. Nope. Test it blindly. Follow your rules perfectly. Accept the brutal losses as incredibly valuable data.
Now, when you do that honest backtesting, your raw strategy results might look exactly like a coin flip, a 50% win rate and a 50% loss rate. Amateurs would throw the strategy away right here, thinking it's completely useless. But remember Jesse Livermore? With our strict 1-to-2 risk-reward ratio, a 50% win rate means the math is already working heavily in your favor. Think about it. If you lose $100 5 times, but you make $200 5 times, you are wildly profitable, even when you're wrong half the time.
But professionals, they don't stop there. The next step is to refine the data. When you backtest a full year of data, you're going to identify specific drawdown days. You'll gather critical data points that reveal exactly where your strategy struggles. For example, you might look at your spreadsheet, run the numbers, and realize that almost all of your major account-draining losses consistently pile up on Mondays, when the market is still kind of waking up from the weekend.
Let's move to the next step and see how this builds into pure mastery. By taking that backtested data and simply creating a new rule, like, okay, I will not trade this strategy on Mondays, you instantly eliminate those consistent losses without changing how you trade the rest of the week. Your win rate can boost from 50% up to 65%, all while keeping that exact same 1-to-2 risk-reward ratio. Boom! You've just refined a simple pattern observation into a highly profitable, mathematically sound trading machine.
So I'm going to leave you with this final crucial question. Are you ready to stop predicting and start observing? It is time to ditch the amateur guessing game for good. Stop looking for this binary perfection where you feel like you have to be right every single time. Find a time window, observe a predictable human emotional pattern, wrap strict risk management rules around it, and then backtest it relentlessly until you refine your way to real profitability. The charts are waiting for you. Get out there and start observing.